Hi, and thanks for tuning in. This video is specifically for teachers, school staff, and administrators that work for a school district who does not contribute towards Social Security but instead contributes to a pension or 403b or similar account on your behalf. Many school employees don't know about the two penalties, the WEP or the GPO, that can negatively affect their Social Security benefit, or if they've even heard of them. In this video, I will show you how these penalties affect your Social Security benefit, what you can do to minimize their effect, and why you should be aware of them. Hi, I'm Kevin Walton, and I'm an RSSA, which is a Registered Social Security Analyst for NARSA. I don't work for the Social Security Administration, but I took a 30-hour course and a 4-hour test so I can speak to you intelligently about Social Security. These topics are near and dear to my heart since I have a relative who recently worked for a school district, put in for retirement, and found out about the WEP and the GPO. She had no idea that they existed. It was quite the rude awakening. She's the reason why I felt the need to make this video so I can help others, maybe help minimize the WEP and GPO effects, or at least let them know in advance on how they can handle these situations. And you don't just have to be preparing for retirement for this information to be important or relevant. Just by knowing the rules and how these penalties work can get you an additional tens or even hundreds of thousands of dollars in Social Security retirement benefits. And again, you need time to make some of these adjustments that you may make for them to work and to take effect. So some state employers, many times including school employees like yourself who work for a district that issue lifetime pensions, they have a different set of rules that others don't have when it comes to how much money Social Security will pay you because of having that lifetime pension. So we're going to get to some of those rules right now. But first, we're going to get to some definitions. The first definition is Social Security benefit. This is the monthly amount you receive from Social Security. Full retirement age. This is a term the Social Security Administration uses when you're able to collect your full monthly Social Security benefit without any age-based reductions. This age is usually 66 or 67, depending on the year you were born. But you can also collect Social Security as early as age 62, you just get less. Non-covered employer pension. This is an employer you have worked for who does not contribute to Social Security in your behalf for the time you worked there. In exchange, they contribute toward a pension or a savings plan for you. Covered employer earnings. This is an employer you have worked for that did contribute 6.2% of your pay in addition to the 6.2% taken from your paycheck, which shows as FICA. In total, this 12.4% gets contributed each pay period to the Social Security Fund. Windfall elimination provision, or WEP, is a reduction in your own monthly Social Security benefit in exchange for having a lifetime pension when working for a non-covered employer. Government pension offset, or GPO. This is a reduction for a spousal Social Security benefit for either a current, deceased, or ex-spouse that results from you having a pension. So to receive your own benefit, based on your own work history, you must be at least 62 years of age. To obtain a spousal benefit, you must be at least 62, and your spouse must first be taking Social Security before you can file to claim a portion of their benefit. Also, Social Security and your own benefit, you have to have worked 10 years and accrued 40 Social Security credits from employers you paid into Social Security. So when it comes to your own Social Security benefit and the spousal benefit, you get to select whichever is higher. Your own benefit could be higher in some cases. You really have to run the numbers, but you don't get both simultaneously. So there are additional rules for ex-spouses and deceased spouses on how you can possibly obtain a portion of their Social Security. But in the interest of time, we'll move on, and you can always contact me later if you have questions on that topic. When you're able to take a portion of your spouse's benefits for the spousal benefit, just know you aren't taking anything away from them by claiming a spousal benefit. Their monthly benefit doesn't get reduced in any way whatsoever. So we're going to go over a scenario today that covers how a school pension can affect your own monthly Social Security, specifically with the WEP reduction and the GPO reduction, which comes into play with the spousal benefit. And it's important to know that it's not a one-size-fits-all. So just because a coworker advised you on how it worked for them and their family when they took Social Security, it doesn't mean that's what's going to work for you. There's a lot of unique factors that go into figuring a monthly Social Security benefit. So it's very important you know that each situation is unique in of itself. So grab a pen and paper and let's dive into it. Before we get too far down the line, please hit the like button if you liked what you've seen so far. I need to make sure other people can find this information because it is valuable to many people throughout the United States. So, how do you know if your current or past employer paid into Social Security? Well, going to the Social Security website and creating an account and downloading your complete earnings is a place to start. Not just your earnings, but your complete earnings. There's an option to have it downloaded into an Excel spreadsheet. So go ahead and do that. And once you've done that, take a look at the numbers. You're going to see some annual income numbers, and in some years you may see zeros or it's just blank. Those zeros or blank years either mean you didn't work that year, or your employer didn't contribute to Social Security that year, or you received a 1099 and possibly didn't contribute to Social Security that year. So the SSA only keeps records on the number of years and total income made for the employers who contributed to Social Security. They may not even know you work or have worked for a non-covered employer, for example, a school district. What this means is that there's a very good chance the Social Security benefit estimate you received in the mail is wrong. It doesn't reflect the school district reductions. That's why it's so important for you to have your own Social Security roadmap to compare to what Social Security shows in their system. Now, I've heard some people say, well, I retired from the school district and I don't have a reduction. I'm getting my full Social Security amount, and then boom, they get a letter in the mail to pay back the overpayment from Social Security once the IRS and Social Security start sharing information, which doesn't happen all that often as it should. And that's how people get caught up in this penalty no man's land. And it can happen years down the line, and it can be for tens of thousands of dollars. Not a good situation to be in. So we're going to take a look at a married couple, Susie, who's 61, and Bob, who's 65. Bob wants to max out his Social Security benefit by waiting until age 70 to start taking Social Security, but Susie would like to take at age 62, and Susie works for a non-covered school district. So we will see the first school district Social Security reduction come into play here, called the WEP. So what we're seeing here is the downloaded income from Susie she got from the Social Security website. She sent it to me. I downloaded it into the software, and this is what it looks like. So we've got 18 years of employment. There's another year down here, you can't see the bottom, in 2021, when Susie went back to work for a year. But the way they start figuring your Social Security benefit is they take yesterday's money and they inflate it. They use an index factor to inflate it to convert to today's money. So if we look at the year 2000, Susie made $28,965. When you apply an index inflation factor to it, that money's now worth $58,133. I know this is a little hard to read, but I just want to give you an idea of what it looks like. So that's the first step used to start calculating your Social Security benefit. Next, we take that income and the software figures out the actual benefit itself. So we take the total dollars earned over 18 years, $798,271, and then we use a factor of 35 years worked. Well, Susie only worked 18 years, right? but there's 17 years where she didn't work for employers who contributed to Social Security. She may work for the school system the other 18 years, but because they don't put money into Social Security, those earnings don't go into figuring your Social Security benefit, so they show up as zeros. Then we take those 35 years and divide it, and it comes up with an AIM, which is an averaged index monthly earning, which is $1,900. Then we take that, and the first portion of that 1,900, 1152, we multiply by 90%. These are called bend points. Then we take the remaining of the 1,900, which is $748, by 32%, we get $239. $1,276 is what Susie's Social Security benefit is. That's what it is before any age-based reductions or WEP reductions. Then we go down here. We have 13 years worked. Substantial years earnings. 13 years. But we just said that Susie worked for 18 years. So why does it say 13? Well, again, for school employees or anyone else who works for a state employer, when calculating the WEP reduction on your own Social Security benefit, there's a minimum income limit threshold you must hit for each year worked. So you need to compare your Social Security earning years, which is what we just saw, to the substantial earnings chart from Social Security. And for each year your Social Security income surpasses the minimum substantial income chart amount for that same year, that's 1 year that gets counted toward minimizing the WEP penalty. So here is the Social Security website substantial earning years minimum thresholds from years 1937 to 2023. So for 2023, the minimum to meet a substantial income earning year is $29,700. Now I'm going to give you this document in the description box, and it won't be all stretched out like this, but here's the $29,700. Each year it goes up. So maybe 2024, it's going to be $31,000, and then so forth. As it goes up inflation-wise, it'll go a little higher. Then what we do is we take each of these documents side by side. So we have your income earning years here. You take a look at your index earning year, let's say for 2000 again, 58,133. Excuse me, 28,965, and you compare that to the year 2000 on the Social Security substantial income earning year document, and the minimum there was 14,175. So what you would do is just basically circle that year. That's one substantial income earning year. Out of the 18 years Susie worked, she has 13 of those years that count as substantial income earnings years. Now again, this is for your Social Security benefit and for people who have pensions. People who don't have state pensions, we don't have to worry about any of the substantial earning year stuff. There is no WEP and GPO penalty. This is only when you have a pension and how it affects your Social Security benefit. So you literally have to have both printouts in front of you to do this. So for Susie, what she has is equates to a 60% penalty in her WEP reduction on her Social Security benefit. That's a lot of money. So how that works, if you have 20 years or less of substantial income earning years, employers you worked for that contributed to Social Security, you only get 60% of your Social Security benefit. So she has 13 years. So she's got to work 8 more years for companies that contribute to Social Security, and she has to make that minimum threshold of income as well. 8 more years before she'll even get another 5% on her Social Security. And then if she works for 22 years, she gets another 5%. 23 years for those companies, 55, and all the way up to 30 years. If she gets 30 years or more worked for companies that paid into Social Security, there will be no WEP penalty. She'll get 100% of her full retirement age Social Security benefit, as long as she takes it at 67 years of age. But a lot of people are caught up in this number right here. A lot of people have worked for 20 years or less for companies that paid into Social Security. So is it worth it? How many more years do you have to work to get this to go up a higher Social Security benefit? Where do you fit in that 30 years? How close are you to those 30 years? So we see here Susie's WEP adjustment gives her $700 a month in Social Security. However, she also took Social Security early prior to her full retirement age, which in this case is 67. So by taking Social Security early, she gets an additional reduction, an age-based reduction. So that will take her less than $700. That isn't even equating right here. This $700 is what she gets if she takes age 67. But taking age 62, it's even going to be lower. So the age-based penalty can also be looked at as an incentive, depending how you look at it. So if you take Social Security at your assigned full retirement age, at age 67, you get 100% of your benefit, not including the WEP. Now, if you take at age 62, you take 30% less than what you get at age 67. And look, between 68 and 70, it grows 24%, 8% per year. So by taking at age 70 versus 62, you're going to get, including inflation, about 70% more in Social Security if you wait to take until age 70. But that doesn't always work for everybody. Everybody's situation is different. But it's important to know these numbers, how you get less of Social Security the earlier that you take it. And again, you got to apply the WEP penalty on top of that. So it's an owie. It hurts. So we're going to go over a chart that shows actual numbers and benefits here in a moment. But looking again at these WEP numbers, it's very important you know where you fit in the number of years you've worked for employers that paid into Social Security. And if you want to reduce your penalty, you just simply have to work more years for employers that pay into Social Security. Easy for me to say that. But you have to know where you fit in here, so you make a plan on whether or not you want to work for those types of employers or not. So we saw that the minimum substantial earning year income for 2023 is $29,700. If you're thinking of retiring, collecting Social Security, and working somewhere else all at the same time, just know your Social Security has an earnings limit prior to age 66 that as of 2023 allows you to make $21,300. Now this is if you plan to take Social Security and work at the same time. When you do that, less than age 66 and below, you're going to get a threshold. You cannot make any more than $21,300. If you go over that, you have to pay back Social Security $1 for every $2 made. So let's say you go to work for a company, you want to get an additional substantial income earning year making $30,000, and you've already started taking Social Security. If you make $30,000 while taking Social Security, that's $9,000 roughly more than what is allotted. You're going to have to pay back $4,500 to Social Security. because you made too much money. Now also, as of the year 2023, if this year Susie turned 67, the year of your full retirement age, they give you more income leeway, so she can make $56,520 instead of the $21,300 if she wants to work and collect Social Security. But that's only for that 1 year. They'll let her make that much money. If she makes over $56,520, she'll have to pay back $1 for every $3 made. Now keep in mind that $56,520 may go up each year as inflation goes up. Also know that after your full retirement age 68, you can work and collect Social Security with no penalty. Don't confuse this with taxes. This is not a tax. This is an income penalty. Taxes are separate. And yes, your Social Security can get taxed. So you can make as much money as you want and still collect Social Security without an earnings penalty after your full retirement age. And you might be able to make enough money to make another substantial earning amount for that year. So you can inch closer to that 30 years and reduce your WEP penalty. So reducing the WEP reduction has less obstacles when you choose to work for a new employer who does contribute to Social Security while collecting Social Security after age 67. Also, if you have additional investment accounts, it's always a good idea to let your financial advisor and CPA know that you're going to continue working for employers that contribute, because that could change your tax brackets. You want to know before you start working for those employers what that may or may not do. So if you've ever seen a 70-year-old working at McDonald's, that may be someone who worked for a non-covered employer at one time, maybe a school district, and is adding on another substantial earning year to minimize their WEP reduction. Or maybe they just like working for McDonald's and love their food. But just know a WEP penalty cannot completely be zeroed out, cannot completely zero out your Social Security benefit in total. Everybody who's worked the minimum amount of hours and has earned the 40 Social Security credits will get some form of Social Security. However, the GPO reduction that is on the spousal benefit, that can totally zero out your Social Security benefit. We're going to take a look at that next. But if you like what you've seen in the video so far, please hit the like button so other people can find this video as well. Let's get going on the GPO now. Let's quickly take a look at Susie's GPO versus the WEP and what it looks like with all of the age reductions and the WEP reduction as well. We got right down here in the bottom right, $492. That's what her net Social Security benefit is going to be, including her WEP reduction and her age-based reduction for taking early at 62. That is a far cry from the $1,276 that she received from the Social Security Administration in her letter. So it's important you do your own homework or obtain an independent Social Security earnings review report to compare to what you're receiving in the mail from Social Security. Excuse me. It'll save you a lot of time and money down the line. So as I said prior, the WEP and GPO penalty figures are nowhere on the Social Security statement. So the WEP penalty applies again to your own Social Security benefit and your own work history when receiving a non-covered pension. When taking the spousal security benefit, Social Security benefit, or switching from your own benefit to the spousal benefit, because you can do that if it happens to be higher than your own benefit. The WEP goes away, but now the GPO penalty comes into play. So for school district employees, there's no escaping a reduction in benefits when you have a lifetime pension. It's either WEP or GPO that gets applied to your Social Security. So back to our example for Susie and Bob, let's look at a worst case scenario and go up from there. First, we need to know Bob's own Social Security benefit amount In this case, it's $3,141, which is based on the total amount of income generated and multiplied by an inflation factor, divided by the same 35 years, and multiplied by those same 3 bend points. And with the additional age reduction, that gets applied to reflect Bob taking Social Security at 62 prior to his full retirement age and prior to his preferred age of 70. So Bob's benefit at 62 is $3,141, and again the software will do all of the heavy lifting and calculations there for you. So what's higher, the WEP Social Security benefit or the GPO spousal benefit? The maximum spousal benefit Susie is able to get from Bob based on his filing age of 62 is 50% of his benefit, or $1,570.50. Now she gets that $1,570 if she files at 62 and she has no WEP. This is not including the WEP at this point. So also, this is what 1570 is if Susie takes at age 67. She gets the full 50% if she takes at age 67, or full retirement age. If she takes early at age 62, then she gets an age reduction there as well. Susie's monthly pension is to be $2,000. Now the first step in the GPO reduction formula is the pension amount gets multiplied by 66%. That's a constant, which is in this case $1,320. That gets subtracted from Bob's $1,570. That only leaves $250 for a Social Security benefit. But again, Susie's got the age reduction benefit on top of that, so it's going to wipe out her GPO, her spousal benefit, altogether using the GPO. So as we can see, the substantial earning income rules do not apply with the GPO and the spousal benefit. That only applies to your own Social Security benefit. So you need to compare the two, the WEP and the GPO, to see which gives you more money. And you have to have the numbers to be able to do that. So in this case, with Bob taking Social Security at age 62 and Susie also taking it at 62, being that the GPO is zeroed out the Social Security benefit for Susie on the spousal benefit, she needs to go back to her own benefit and take that WEP reduction, which, as we saw earlier, was left her with $492. Again, far cry from the $1,276, but it kind of is what it is. But you need to know this information well in advance of retirement to give yourself time to make any kind of adjustments you may want to make. Now, I mentioned a second ago that if you take the spousal benefit and you choose to take Social Security earlier than your full retirement age, in the middle column here, this percentage of spousal benefit, this goes over the numbers. So if you take at age 62 and the spousal benefit, and let's say you don't have a WEP, you're not going to get 50% of your spouse's benefit. You're going to get 32.5% if we look at that middle column. And if you wait to age 63 to file, you're going to get 35% of your spouse's benefit. Up to age 67, once you reach 67, then you reach the maximum 50% of your spouse's benefit. If you take less than that, you get less. But notice, waiting to age 70, you don't get any benefit. So the maximum spousal benefit is at age 67, not age 70. So there's no use in waiting to age 70 for the spousal benefit to grow, because it won't. It only pays to wait to age 70 for your own benefit to let it grow. So what are some ways to minimize a GPO reduction? Some teachers and employees who don't do summer school and choose to work other jobs for covered employers will earn income and contribute to Social Security, but will that income be enough to meet the minimum substantial earnings amount for the WEP to add to their substantial income earning years? It's not automatic, and it's not impossible, but it'll be difficult to work a second job if you don't leave your job at the school district and make $29,300 in 2023. Keep in mind, the substantial earnings limit goes up a bit each year, so in 2024 the minimum income limit for a substantial earning year may be $31,000. And it'll go up a little bit after that, depending if we have inflation or not. Another way to minimize GPO, there's a rare last 60-month rule that can work for some school district employees, and it can eliminate the GPO altogether. Here's how it works. If a school employee starts working for a different school district, where that new district contributes to Social Security and contributes to the same pension plan as the prior district you just left, if you worked there for the last 5 years prior to retiring, it can eliminate the GPO for the spousal benefit altogether. Now, it's not available for the WEP and your own benefit. It's only available for the GPO, which is associated with the spousal benefit. Again, there are several qualifiers to meet this last 60-month rule, and I'm not at all advocating that you leave your current job to go to another district. But the earlier you know this information, the better off you'll be, and give you more time to make any adjustments if you choose to make them. So let's switch the tables here a little bit. Let's say that you are not the one with the school pension and that your spouse is. So how would that affect things? So it doesn't affect your own benefit. However, if your spouse has a higher benefit than you do, their WEP reduction they experience by having a school pension will directly reflect the amount of your spousal benefit you receive. Let's say worst case scenario, if your spouse passes away and your spouse had a higher benefit than you, so you took the spousal benefit, but your spouse had a WEP penalty because they had a pension, the WEP does not get passed down to you. It stops and gets added back in, and then your spousal benefit becomes a survivor benefit and gets recalculated. It's a higher number. So if your personal benefit amount is low to begin with on your own benefit, if your spouse has a WEP reduction on their benefit, and you're going to do a spousal benefit instead of your own because it's higher, it pays to do whatever you can to minimize the WEP for your spouse. That means possibly taking Social Security later, delaying it in order to get a higher amount in order to avoid age-based reductions. Here's what we see sometimes. People say, well, you know what? I'm going to take a retirement at 62 no matter what because I'm just tired of working. If your spouse has a higher benefit than you and you're going to take the spousal benefit, that directly affects you. The spousal benefit should be a joint conversation between the two of you because it directly affects the other spouse, not just when they're alive, but also when one of the spouses passes. If you take too early, that leaves a lower amount maybe than what's necessary. But with certain situations, depending on health and other factors, it may not pay to wait until later to get a higher Social Security benefit. If there's a large WEP and GPO reduction already, it may not pay to work additional years or wait longer to take Social Security. But you have to really look at the numbers. But again, it should be a joint conversation. Here are the numbers I was talking about. This is the maximum payout by Social Security. And the age combination that it comes with is Susie taken at 66, Bob taken at 70. $1,004,000. Based on Bob living to age 85 and Susie living to age 90. Those are the numbers they gave me. You can get those numbers by going to livingto100.com. Again, livingto100.com. And you can put in numbers there and you'll get a longevity number from there. And that I can plug into the software and it'll give me these numbers. But let's say if Susie took at 62 like she wanted to and Bob took at age 70 like he wanted to. Look at the difference in money. It's only $2,000 less versus 62 to 66. So in this case, even though it pays out more at 66, it doesn't pay to wait for Susie to take until 66. Take it 62. It's such a small difference. But again, this is just for these two. These numbers could be wildly different for you, and if you have a spouse, completely different. It's important that you have your own set of numbers. Here is the monthly amount. By waiting to age 70, Susie and Bob, you get a maximum of $5,300 a month, almost $5,400 a month. But that doesn't give them the maximum amount of money paid, because the lifespan has something to do with that. Look at age 62. Bob takes at 62, Susie at 62, $36.33. That's $2,000 less a month. Even over a 10-year period, that's $240,000 difference by taking too early that they're losing. So you've got all of these other age combinations in here that you can look at that fit your situation. Here's a chart that shows Susie's retirement benefit annually and Bob's retirement benefit annually. You notice the spousal benefit for Susie and Bob is blank because the GPO is there. It wiped out the Social Security benefit altogether. Survivor benefit kicks in here when Bob passes away, 85. Now some people tell me, well, I get $5,900 a year. Bob gets $54,000. When he passes away, I get his $54,000. Not always, because Susie still has the WEP penalty that does take into account what she gets from Bob. So instead of getting $54,000 from Bob, she gets $38,059, a combination of her benefit and a portion of Bob's. Again, these numbers are all different. This is based on Susie taking at 62 and Bob taking Social Security at 70. So in conclusion, we can help you figure out what your WEP and GPO penalties may be, the dollar differences between the different Social Security benefit options, which Social Security claiming ages, combination ages, will give you the most volume of dollars over a lifetime based on your longevity, how many years of substantial earnings you have, and give you advice on how to lessen the WEP and GPO penalties that specifically work for school district employees who have non-covered employers. So it's vital that you do your own homework ahead of time for the long-term adjustments and short-term. And you need your own Social Security data to compare to what Social Security Administration has in their system. So I want to thank you for tuning in. The investment time is that you've given to watch this whole thing. Please like the video if you think this is of value so others can find it. An even bigger thank you for the dedication for working for our school system and encouraging our kids to be the best that they can be. And again, thank you for your time, and feel free to contact me with any questions. Bye.